The outcome of July 9 could be the single biggest threat to the US and world economy in a long time. A blanket 10% tariff is already targeting almost every import as of early April. But this was only the appetizer, because the administration then rolled out a second wave scheduled for July 9 and staggered through August that would slap European Union goods with up to 50% duties, hit Japan and South Korea at 25%, and layer 25 to 40% on dozens of smaller economies stretching from Tunisia to Laos. Stay with this because the immediate headline shock is only the beginning. We will see how central banks are scrambling, how CEOs are redrawing supply chains in real time, why corn and soybean growers fear a lost decade, how steel mills that cheered at first are now warning about input shortages, and how the memory of the 1930s and the mild rerun in 2018 could morph into an outright stagflation spiral. First, the raw macro picture. Federal Reserve officials quickly sliced their gross domestic product projection for 2025 to roughly 1.4%, a figure echoed by Oxford Economics and, with a slightly gloomier tilt, Capital Economics at about 1.5. Core inflation has been revised up by roughly 1 full percentage point by every major forecaster, with Capital Economics flagging 4.5% and Oxford Economics almost 4%, all of them pointing directly at tariff pass-through and knock-on wage demands. Chicago Federal Reserve Chief Charles Eddins, normally cautious in his public phrasing, told reporters that the baseline outlook now builds in a significant slowdown and a longer bout of price pressure because of trade tensions. That understatement is doing heavy lifting. Markets heard the subtext immediately, yanked forward their expectations for rate cuts, and sent treasury yields on a wild ride, spiking on the fear that the central bank would need to stay restrictive even as growth stalls. At this stage, you might wonder if these are just academic spreadsheets or if households will feel it. Deutsche Bank says the average family will lose more than $2,000 a year from the April tranche alone, and CBS News calculates that low-income families could see roughly $1,000 evaporate annually. Combine that with the July and August waves and you are looking at a stealth tax larger than the typical annual gasoline bill for many households. Before diving into sector carnage, keep an eye on retaliation because it acts like an accelerant. China moved first, slapping 10 to 15% levies on $21 billion worth of United States farm and chemical products immediately after Washington's April step, and officials in Beijing signaled that any country making side deals with the United States at China's expense would face its own penalties. The European Union, often slow to coordinate, had a list of counter-tariffs on everything from bourbon and beef to large civil aircraft ready within days, and Brussels insiders said privately that the only reason the list was not published instantly was the narrow hope of a last-minute negotiation before the July 9 deadline. Tokyo, still haunted by the 1980s Plaza Accord experience, quietly drafted its own measures aimed at iconic United States consumer brands, while Seoul warned that the National Assembly would not sit on its hands if 25% blanket tariffs hit Korean autos and electronics. Even smaller players are gearing up. Brazil hinted it could limit soy purchases, and India, still smarting from earlier steel and aluminum duties, prepared localization rules that would make life miserable for Silicon Valley cloud providers. Pause on that, because the chain reaction is how a tariff roundhouse punch morphed into a global trade war. The Organization for Economic Cooperation and Development did the math and concluded a fresh 10 percentage point tariff hike worldwide would shave roughly 0.3 percentage point off global output over 2 years. The International Monetary Fund cut its worldwide growth call to 2.8% for 2025, down from 3.3%, and flagged United States tariffs now at century-high levels as the primary drag. Zoom in on technology first because consumers feel that pain fastest. Apple, whose iPhone assembly lines still run mainly in Zhengzhou, faces a potential 25% duty the moment devices roll into Long Beach. Executives can shift a sliver of production to India or Vietnam, but not enough in the next few quarters to dodge the levy. So either margins compress or retail prices climb. A similar story unfolds at every major hardware firm: laptops, gaming consoles, networking gear. Count up the component flow: semiconductors, printed circuit boards, optical sensors. Almost all cross at least one border. Each hop risks a toll. The threat extends beyond finished gadgets. The United States Trade Representative opened investigations into semiconductor and pharmaceutical imports, signaling that chips made in Taiwan or South Korea and active pharmaceutical ingredients from India or Europe could soon carry extra duties. Silicon Valley veterans remember the 2018 shock, when price tags rose by roughly $200 on some laptops. This time the scale is larger and the tariff ceiling higher. Investors noticed share prices of big box electronics retailers slumped within hours of the July announcement as analysts modeled thinner holiday season margins. Yet, here is the kicker. Many domestic chip fabs depend on overseas wafers, rare earth magnets, or specialty chemicals, so the supposedly protected firms get hit on their input side too. Agriculture, meanwhile, is where retaliation lands squarely. China bought roughly 1/3 of all United States soybeans before the first Trump term's trade skirmish. That dropped by half once Beijing imposed its earlier tariffs. The new duties deepen the wound. Growers in Iowa and Illinois already struggle with lower forward contract prices because grain traders assume Chinese demand will keep slipping. The European Union threatens its own levies on corn, beef, and whiskey, a particularly painful mix for Midwest exporters and Kentucky distilleries. Beyond the rhetoric, actual ships are diverting. Brazil, Argentina, and Russia are stepping in to sell soy, corn, and wheat to Chinese state grain firms at slight discounts, locking United States farmers out. A University of Illinois study points to the risk of a multi-year income slide rivaling the 1980s farm crisis if export channels remain blocked. Insurance costs are rising as well, since political risk now includes tariff-driven counterparty default. Yet, the administration argues farmers will benefit in the long haul as trading partners cave in open markets. That view has few allies outside the executive branch. Most economists counter that China and the European Union are already building alternative supply chains, from Argentine soy to Canadian wheat, and once entrenched, those new links rarely snap back quickly. Manufacturing is next on the block. On paper, a 50% tariff on foreign steel and a 25% tariff on imported cars should boost United States mill utilization and auto assembly. Reality is messy. Domestic carmakers rely heavily on parts from Mexico, Canada, and Asia. A wiring harness made in Juarez might cross the border multiple times before final assembly in Michigan. Each pass now incurs the 10% universal tariff, perhaps the 25% Japan or Korea duty, and possibly steel levies on raw coil if it originated in Europe. Detroit executives warn of at least $1,000 in extra cost per mid-size vehicle. They can either raise sticker prices, eat margin, or cut features. Meanwhile, European and Asian automakers threaten to move some North American assembly south to Mexico's tariff-free zone under other trade agreements, leaving United States workers vulnerable. Heavy industry faces similar headaches. Aerospace giants import specialty titanium from Russia and engines from Europe. Medical device makers source precision components from Germany and Singapore. When tariffs lift those costs, companies pause investment or search for substitutes, delaying factory expansions. Moody's chief economist Mark Zandi ran a modeling exercise and found the United States could lose nearly 2% of gross domestic product and face unemployment near 7.5% under a full trade war scenario. The same simulation shows the worst pain landing in states that narrowly supported the current administration, an irony not lost on political strategists. Policy reactions tell their own story. The Federal Reserve in June signaled it was in no hurry to cut rates despite decelerating growth, because tariff-driven price spikes are not a demand issue that lower rates can solve. Chair Jerome Powell told lawmakers that inflation has stayed stubborn and that the central bank would learn a great deal more over the summer on tariffs, a diplomatic way of saying the main uncertainty now stems from the White House. The central bank's predicament is stark. Easing could stoke further price rises, tightening into a slowdown risks recession. Wall Street is calling it a stagflation trap, reminiscent of the early 1970s. Energy markets complicate matters. Crude oil prices ticked up after rumors that Middle East suppliers might match the United States in using tariffs as leverage over political disputes, which would feed directly into gasoline costs, amplifying the consumer burden. Internationally, confidence is eroding. The World Bank notes that trade growth could slump to about 1.7% next year, roughly half the pre-tariff trend. Global supply chain managers, spooked by the unpredictability, are redrawing logistics maps, shifting inventory from just-in-time to just-in-case. That translates into higher warehousing expenses and longer delivery times. The IMF's chief economist, Pierre-Olivier Gourinchas, warns that rising uncertainty alone can trim investment, even before any tariff hits cash flow. Equity markets are validating that view. On the day the July 9 details emerged, the S&P 500 shed nearly 1%, the tech-heavy Nasdaq fell deeper, and volatility futures spiked. Fixed income markets flashed warning lights. The 2-year to 10-year Treasury curve flattened sharply, often a harbinger of recession. Corporate bond spreads widened, especially for companies with global supply chains. Credit Suisse analysts now estimate that if tariffs stay in place through the first quarter of next year, downgrade risk for investment-grade industrials could rise by 60%. It is worth stepping back to compare with the earlier skirmish in 2018 and 2019. That round, anchored on 25% duties on Chinese goods and metals, nudged United States tariffs to levels not seen since the 1930s. Studies by the Federal Reserve Bank of New York later concluded those tariffs shaved roughly 0.4 percentage point off United States gross domestic product while raising import prices materially. The new package is larger in scope, deeper in rate, and broader in country coverage. Oxford Economics calls it a tariff barrage without precedent in recent history. Morningstar labels it a self-inflicted economic catastrophe, a stark phrase for an institution known for measured language. Even analysts who supported selective tariffs for national security in the past say the current iteration is overreach. Harvard trade economist Danny Roderick, often sympathetic to strategic protection, argues that blunt instruments of this magnitude invite retaliation rather than negotiation. Columbia's Adam Tooze sketches an even darker scenario: fragmentation of the global order as blocs coalesce around separate standards, payment systems, and security alliances. That fear is not theoretical. In Brussels, officials now openly discuss accelerating digital sovereignty programs so that European data and cloud infrastructure remain independent of United States providers if trade ties continue to fray. Beijing has for years pushed self-reliance in semiconductors and energy technology. The new tariffs strengthen its resolve. Moscow, under long-running sanctions, is offering discounted commodities to both Beijing and New Delhi, undercutting United States exporters. Meanwhile, supply chain resilience talk in Washington sometimes conflates decoupling with friendshoring, but the sheer size of tariffs risks alienating allies rather than binding them. Seoul's trade minister said bluntly that friendshoring cannot mean a permanent cost disadvantage for Korean firms. Tokyo's policy circles echo that sentiment, warning of strategic divergence if the United States treats allies the same as adversaries, yet the administration insists the long game is worth short-term pain. Officials argue that persistent trade deficits prove the system is broken, that past efforts at multilateral reform stalled, and that only dramatic action forces counterparts back to the table. They highlight anecdotal wins such as a tentative European Union pledge to buy more liquefied natural gas and a Japanese promise to discuss auto tariffs. Critics counter that those concessions are minor compared to the macro damage. Oxford Economics notes that the European Union offer touches a market that already sources a growing share of gas from the United States due to geography and price, not tariffs. As for Japan, analysts point out that its automakers have already shifted production to North America heavily. A 25% threat simply accelerates investments that were happening anyway. Meanwhile, the costs are immediate and quantifiable: higher consumer prices, weakened export demand, uncertainty stalling investment. Looking forward, 3 pivot points will determine whether the situation stabilizes or spirals. First is the August 1 deadline, when 25 to 40% duties on dozens of smaller economies take effect. Many of those countries serve as upstream suppliers in complex value chains. Tariffing them catches United States companies in the crossfire and removes low-cost sourcing options. If deadlines hold, analysts expect an immediate pass-through into third-quarter earnings warnings. Second is the Federal Reserve meeting in September. Should inflation data reflect a clear tariff impulse, the central bank may harden its stance, signaling no cuts for longer. Markets would price that as policy error risk, potentially triggering broader sell-offs. Third is retaliation crystallization. If China or the European Union actually impose their prepared lists in full, soybean exports could collapse. Airbus and Boeing orders could shift, and whiskey and denim producers could see tariffs at both ends of the Atlantic. The multiplier could be severe. Moody's finds each $1 reduction in United States farm income drags an additional 70 cents off local service economies through lower spending. Some commentators search for silver linings, suggesting that pain may be the mother of innovation. Domestic battery plants under construction in Nevada and Georgia could benefit if imported cells grow pricier, nudging more upstream cathode production onshore. Yet even optimists admit capital expenditure pivots cannot happen overnight. Factory permits, environmental reviews, and skilled labor shortages delay build-outs by years. Meanwhile, consumers front the cost instantly. The gap between theory and lived reality is widening, and that feeds political backlash. Recent polls show a slim majority of voters supportive of targeted tariffs on national security grounds, but substantially opposed to across-the-board levies that raise daily expenses. Retail groups, farm lobbies, and even several heavyweight manufacturing associations that once applauded selective protection are now urging moderation. History offers sobering parallels. The Smoot-Hawley Tariff Act of 1930 raised duties on over 20,000 goods, inviting backlashes that deepened the Great Depression. Economists avoid one-to-one comparisons because today's monetary, fiscal, and social safety nets are stronger, yet the core lesson: mutually destructive tariff spirals remains. The 2018 mini-trade war, mild by comparison, still shaved points off growth and pushed firms toward costly supply chain gymnastics. Scale that up now and the margin for error vanishes. In the end, whether one roots for strategic self-reliance or free trade, the numbers tell the same immediate story: slower growth, higher inflation, more uncertainty. The Federal Reserve pencils in gross domestic product at roughly 1.5% for 2025 instead of the earlier 2+. Core inflation sticks closer to 4 than 3. The IMF slices global expansion to below 3%. Moody's warns of an unemployment spike if escalation persists. Households face larger grocery and gadget bills, farmers lose their best customers, manufacturers struggle with input prices, and tech firms juggle cost spikes on both components and final assembly. Allies mull countermeasures, rivals exploit cracks, and markets price stagflation risk. Unless negotiations reverse course or exemptions proliferate, the tariff barrage could become the single biggest self-inflicted threat to the United States and world economy in a generation.